5% March 2023 US CPI could fall to 4% by year end if oil doesn't fly. This is US CPI in 5 charts. So what do you think? Is US CPI going up or down by the end of this year? Welcome to the Become a Better Investor community. Let's get started. Remember, you can download this chart deck for free by clicking on the Get the PDF link at myworstinvestmentever.com or by clicking the link in the description. Before we start, remember that CPI is not inflation. CPI is an index of prices. Inflation really talks originally about inflating the money supply and therefore debasing money. So here you'll see me talking about CPI and not so much inflation. They are different, but there are similarities, and if CPI is rising, chances are also inflation is rising. Now, U.S. March CPI was 5%, which is down from 6% in February, a pretty significant drop, and of course it's way off of its 9.1% peak, which was in June of 2002. Here you can see the chart of how fast it's coming down. I also show the long-term average, which is about 2.5%. So let's look into it a little bit more deeply. First, let's consider food, which accounts for 14% of U.S. CPI. In March of 2023, the food component was up 8.5%, but that's also come off of its August 2022 11.4% peak. The chart, as you can see, shows that the food prices overall went racing up above CPI, and now they're steadily coming back down. Now, what's the next component of CPI? Well, that's energy. Energy is a wild ride. A chart that you see here shows the energy component of CPI swinging violently, and that is about 7% of overall CPI, and the March 2023 energy component was down into the negative territory, minus 6.4. That's a massive fall from its peak, which is in June 2022, when it was up 41.6%, when oil prices were rising very, very fast. The end result of this collapse in oil price means that it's pulling downward pressure on US CPI. Now, oil price could come back up, and if for some reason oil price starts to swing, it will start to bring US CPI up. The time lag is not very long, so we have to watch that for sure. Now, in March of 2023, all other items were flat month on month. Now, when I say all other items, I mean excluding food and excluding energy. Now, we can also call these commodities and services, and this makes up 79% of CPI. So what's in the commodities and services? Well, commodities are things like clothing and cars, and services are things like healthcare and rent. Now, what we can see from this particular chart is that the commodities and services were at about 5.6 in March, and they're down from 6.5 high, which was March 2022. There's a lot less volatility in this more of a core inflation component. And what we can see is that it's slowly coming down. The reason why it's slowly coming down is because the calculation for rent is owner's equivalent rent. And owner's equivalent rent is adjusted over time. Now, we've seen the share of the price of housing prices rising and then crashing. The crashing part of the housing market has yet to start being reflected in this commodities and services component of CPI. But when that comes in, it's going to provide a steady down cycle for this component. And again, this component is huge. The owner's equivalent rent is about 35% or so of overall US CPI, so it's the largest component. And I'm going to bring it all together now to try to look at where I'm forecasting things for US CPI. What I'm saying is, without a surge in oil price, because we know that if oil price surges, what we're going to see is that very quickly, within 2 or 3 or 4 months, we'll see CPI starting to rise again. But without that surge, we forecast that CPI could end 2023 at 4%. In fact, it could end even lower at like 3%, because as you can see from this chart I show, my forecast period is that it actually is starting to slow down in its descent. So you could even argue 3 to 4% by the end of 2023. Now there's two things that could derail this forecast of year-end 2023 4% US CPI. The first is an oil surge, which would push the year-end 2023 slightly higher than 4%, but only slightly because it does take a few months for that oil price rise to impact CPI. And then, of course, on the other hand, a US recession would quickly bring CPI below 4%. And I think we are heading into a recessionary period in the US, and the result of that is that I do think we could see that inflation comes down even more. Why does inflation come down during a recessionary period? Because the demand for products and services is falling, and it's harder for companies to support the prices that they're trying to sell at. So what are the key points? March 2023 US CPI was 5%. That's down a pretty significant amount from 6% in February and off of its June 2022 peak of 9.1. March 2023, the food component was up 8.5%, but has come off its August 2022 11.4% peak. March 2023, the energy component was down 6.4. And when I say down, I mean negative. It's a massive fall from its positive 41.6 June 2022 peak. That shows you the impact of falling oil prices. And in March of 2023, all other items, those are commodities and services, were flat. These account for 79% of the overall CPI. They were flat at 5.6, and they were down from March 2022, 6.5% high. And without a surge in oil price, we forecast CPI could end 2023 at 4%. So let's wrap it up. There's two things that could derail this 2023 year-end 4% target, and even possibly 3%. First, an oil price surge would push year-end 2023 slightly higher than 4%, but only slightly higher because it takes a few months for an oil price rise to impact CPI. Or a recession could quickly bring CPI down below 4%. And that's what I think is going to happen in the US. So 5% March 2023 CPI could fall to 4% by year end if oil doesn't fly. Remember, you can download the whole chart deck by clicking on Get the PDF link at myworstinvestmentever.com or by clicking in the link in the description. Have a great day.